All right, everyone, welcome. Today we're diving into one of the biggest, most critical moments in the life of any company, the decision to raise money by issuing shares. Now, I know what some of you might be thinking, but this isn't just for the finance nerds in the room. This is a core concept that every single one of you as a future manager or entrepreneur absolutely has to understand. Why? Because it's the engine of growth. It's how great ideas actually become great companies. So let's get into it.
Okay, so here's our game plan for today. We're going to build this thing from the ground up. First, we'll talk about the big picture, the why. Why do companies even need this capital in the first place? Then we'll get into the nitty-gritty, the actual mechanics of how shares are issued. After that, we'll tackle pricing, and specifically the difference between par value and premium. And I'm telling you, this is an area that really trips people up, so we'll spend some good time there. From there, we'll shift gears from accounting to strategy, talking about ownership, dilution, and control. And finally, we'll put it all together and step right into the CEO's office to unpack the tough decisions they have to make.
So, let's start at square one. Before we get into any journal entries or T accounts, we have to understand the fundamental business reason for all of this. I mean, why does any company, whether it's two people in a garage or a giant global corporation, need to go out and ask for money? Well, the answer really boils down to one word: growth. You've got to have fuel for the engine if you want the business to go anywhere.
I mean, just think about it for a second. Think about the biggest companies you know. Apple started in a garage. Amazon, it started as a humble online bookstore. These were fantastic ideas, right? But an idea on its own doesn't buy you a new factory, it doesn't build data centers, it doesn't pay for a huge marketing launch. There's this massive gap between having a brilliant idea and building a global business. And the bridge across that gap, it's capital. It's the one thing that turns all that potential into reality.
And that right there brings us to the core of our topic today: equity financing. Now, it is so important that you don't confuse this with debt financing. You see, when a company gets a loan from a bank, that's a liability. It's a promise to pay the money back, usually with interest. But with equity financing, there's no loan. There's nothing to pay back. Instead, the company is selling a little piece of itself. Investors hand over their cash, and in return, they get an ownership stake. They become partners, not lenders. And that's the kind of capital that really lets a company swing for the fences.
All right, so we've covered the strategic why. Now it's time to roll up our sleeves and really dig into the mechanical how. How does a company actually create these little slices of ownership and turn them into cold, hard cash? This, right here, is where accounting stops being just about keeping score and starts being a really powerful strategic tool. Because how you structure and record these deals, well, it has huge implications down the road.
The first key term we absolutely have to lock down is share capital. So when a company gets cash from selling shares, think back to our old friend, the accounting equation. Assets equals liabilities plus equity. The cash coming in obviously makes your assets go up, but what about the other side of the entry? Well, and this is crucial, it does not go under liabilities. This isn't a debt. It goes straight into owner's equity. This share capital account is the bedrock, the permanent capital base of the business, put there by its owners. It's their skin in the game.
So, how does the company actually get these shares into investors' hands? Well, there are basically two main paths you can take, and this choice is a major strategic fork in the road. On one side, you've got a direct issuance. This is really common for early-stage companies. They might sell shares directly to a few angel investors or a venture capital fund. The upside? It's usually cheaper, and you can move faster. The downside? Your reach is pretty limited. On the other side, especially for something big like an IPO, companies almost always go with an indirect issuance. They hire an investment bank to handle the whole process. The bank brings in expertise, a massive network of investors, and a lot of credibility. It'll cost you more in fees, for sure, but for a big, complicated deal, that expertise is often priceless.
Okay, let's pause here because we've come to a topic that, I've got to be honest, often gets students tangled up when they first see it. And that's the whole idea of pricing shares, specifically the difference between par value and share premium. So I really need you to focus in here, because understanding this isn't just about getting a question right on a test. This is fundamental to being able to correctly read the equity section of any company's balance sheet.
First up, let's talk about par value. The best way to think about this is that it's basically a legal fossil. It's a holdover from way back in the day in corporate law. It used to have a real purpose, but today it's pretty much just a formality. Companies will set the par value at a ridiculously tiny amount, like a penny or even a fraction of a penny. Why? Because it has absolutely nothing to do with what the share is actually worth in the real world. Think of it as just a legal box you have to check. That's it.
Now, the number that really matters, the real story, is the share premium.
Sometimes you'll see this called additional paid-in capital. It's the same thing. This is simply the amount that investors pay for a share over and above that tiny par value. So let's say a share has a 1-cent par value, but it's sold to investors for $20. Well, 1 cent gets recorded as par value, and the other $19.99, that's your share premium. This is where the real money comes from. It's a direct signal of the market's confidence in your company's future.
Okay, and here it is. This is probably the single most important accounting rule in this whole section, so I want you to mentally highlight this. Even though share capital, that's the par value part, and share premium both live in the equity section of the balance sheet, they absolutely must be kept in separate accounts. They have to be. They tell two completely different parts of the story. One is the legal formality, the other is the actual market value. Lumping them together is a fundamental mistake, and it will lead you to completely wrong conclusions. Keep them separate.
Let's make this real with our Innovate Corp example. Just look at how this plays out. Say they issue 1 million new shares, and each has a par value of just 1 cent. So the amount recorded in the share capital account is just $10,000. But they managed to sell those shares on the market for $1 each. That means $1 million in cash comes into the company. The difference, that $990,000, gets recorded in that separate share premium account. See how that works? The total equity goes up by $1 million, but it's broken down properly to show the full picture. 10 grand of legal capital and 990 grand of real market investment.
Okay, so that $1 million in cash for Innovate Corp, it doesn't just appear out of thin air. It comes with a cost. But with equity, the cost isn't an interest rate you pay to a bank. The cost is ownership. And this is where we need to pull up from the accounting details and look at the 30,000-foot strategic view. We're talking about the fundamental trade-off that every single founder has to face. The trade-off between growth and control.
And the key word here is dilution. It's really just simple math. Imagine you and 9 friends start a company. There are 10 of you, so you each own 10%. But now you need money, so you issue 10 brand new shares to a new investor. Now there are 20 shares in total. Your 1 share is now 1/20th of the company. You only own 5%. Your stake has been diluted. Now the hope, of course, is that the new money makes the company so much more valuable that your new 5% is worth way more than your old 10% ever was. You own a smaller slice of a much, much bigger pie. But you still own a smaller slice.
So let's go back to our Innovate Corp founder. Before she goes out looking for cash, the picture is simple. She owns the whole enchilada, 100%. Every decision is hers. She has total, absolute control.
But she's got these huge plans for the company that need that $1 million in capital. So she makes the tough call. The company authorizes the creation of a whole new batch of shares, and those shares get sold to an outside investment group.
And here's the result. In exchange for that $1 million, the new investors now own 1/4 of the company. Look what happened to the founder's stake. It's been diluted from 100% down to 75%. Now, don't get me wrong, she's still the majority owner, and that's a big deal. But she's not the only owner anymore. She now has partners who have a say in the big decisions.
And really, that's the whole ballgame right there. This is the fundamental bargain of equity financing. You give up a piece of the pie, you dilute your ownership, in order to get the cash you need to make the whole pie bigger for everyone. It is the central strategic trade-off of this entire process.
So let's pull all these threads together now. I want you to imagine you're not just a student analyzing this from the outside. I want you to picture yourself in the CEO's chair. Because trust me, the decision to issue new stock is never just about the accounting. It's one of the most complicated, high-stakes strategic choices a leader will ever have to make. And the ripples from that decision will affect the company for years and years to come. You know, a good leader doesn't just wing it. They follow a process. First up, you've got to assess your needs. How much cash do you really need? This can't be a wish list. It has to be a disciplined plan. Second, you evaluate the method. Should we do a private deal or go public? Who are we even trying to sell these shares to? Third, and this is maybe the toughest conversation, you analyze the control impact. How much of the company are we, the existing owners, willing to part with? And finally, you have to think ahead. Is this a one-and-done deal, or is this just round one? Because every future round means more dilution. You've got to be playing chess here, not checkers. Now, as you're working through problems for this class, I really want you to watch out for these common traps. Seriously, these are the exact mistakes I see students make over and over again. First, please do not confuse that tiny legalistic par value with the real market value. Second, don't just see dilution as a math problem. Remember, it's about control and power. Third, never forget that share premium is equity. It is not a liability. And last, don't just gloss over the choice between a direct or indirect issuance. It's a huge strategic decision. If you can steer clear of these 4 pitfalls, your analysis is going to be so much stronger.
So look, if you forget everything else from today, please just remember this one thing. Accounting for equity isn't just about the debits and the credits. It's about learning to read the story that the numbers are telling you. And it's a story of ambition, a story of growth, but it's also a story of compromise. It's about that constant balancing act between getting the fuel you need to grow and keeping enough control to steer the ship.
And with that, I'll leave you with a little thought experiment to chew on. There's no single right answer to this. On paper, the math is easy, right? 50% of 10 million is 5 million, which is 5 times more than 100% of 1 million. But the real-world calculation, the strategic and personal decision, that's a whole lot more complicated. How you answer that question, and more importantly, how you justify your answer, will tell you a lot about how you've understood what we've talked about today. Think on that one. Thanks, everyone.